Hi, I'm Stacey Hyde, and I'm back for another episode of Better Financial Health in 15 minutes or less. And today I'd like to talk about a topic called ESG. You may have heard that, you may have wondered what that is. It's environmental, social, and governmental. So, what, and that can mean different things to different people. Some people don't want to own firearm manufacturers. Some people don't want to own tobacco companies. Some people don't want to own oil companies. Some people don't mind oil companies, but they don't want to own any coal mining companies or companies associated with that. Governance can be with, do they have women on their board? Are they friendly to LGBTQ individuals? And are they welcoming? And so different people have different beliefs, and these types of funds exist to allow people to essentially invest their conscience. And it's gotten much, much more popular. And, back 15 years ago, there were one or two investment vehicles that you could use to invest in this. Now there are a wide range of them. And with the growth of ETFs, exchange traded funds, which are baskets of stocks, you can find different investments that allow you to invest the way you want to. One thing that I would tell you to pay attention to is sometimes if you exclude a lot of different things, then your portfolio may become very focused in certain areas, particularly technology, because a lot of the technology companies are newer, younger companies, and they will oftentimes more easily pass some of these screens. So if you're not careful, you could wind up with a portfolio of almost all tech companies. While over the last decade, that has been fabulous, we just don't know that they're going to continue to outperform. And actually, the law of averages says what has performed the best is not likely to continue to perform the best. You always hear past performance is no indicator of future success, and I think that's very true, and you have to keep that in mind and understand what sectors you could be leaving out if you don't want to invest that way. For example, some of the ESG funds will rule out, say, an ExxonMobil. Some of them will not, because ExxonMobil has invested quite a bit in very environmentally friendly drilling, right, in the way they drill, and investments in green energy and things of that nature. So they're not ruled out. But some people, maybe looking back to the Exxon Valdez, they're like, no, I don't ever want to own Exxon based on that. And that's fine. You just need to understand that that may limit your investment choices. And so you have to kind of understand that, okay, yeah, they might could own that. They don't now, or it's a very, very small percentage. And is that worth it to me for this other low cost, very broad based, as I've talked about before, exposure to the market as a whole? So it is important to kind of understand what the trade-offs are when you invest this way. And then some people take the opposite approach. They don't want to own anything that has the ESG screens because they think that it's getting to interfering in their investments. And so they want to make sure that there are no screens like that on their investments. And so it's important to understand that you really can invest the way that you personally feel, but there's also trade-offs for that. In many cases, some people, they're not necessarily doing an ESG screen because they feel strongly about excluding one thing or another, but they could be concerned about what's the regulatory risk. If they are not doing this properly, some clothing manufacturers, if they are not paying attention to child labor laws, if they are not if they're doing business in certain countries, that could open them up to some regulatory risk and some reputational risk. So I think it's important, and you can look at that. And if you're working with an advisor, you can talk with them about what it is that you want to sort of uh, have more of in your portfolio and what you'd like to have less of or even exclude in your portfolio. So that is available, and it's becoming more and more popular, more and more mainstream. I would say it was going straight up super popular, and then it's kind of sort of leveled out now. But there are lots of different ways that you can invest, and I think you can find what you're looking for out there among the universe. But when you're looking, pay attention to exactly what sectors you may be excluding or really underemphasizing, and also what the cost of that investment are, because some of them, they're really not doing a lot of screens, but they're just charging more because they've put a pretty bow on it. So you want to pay attention to that as well. That actually is something the SEC has been looking at here recently. Thanks for tuning in, and I would love it if you would leave a review on Apple Podcast if you listen there, in the Google Play Store. It really does help to get our podcast out to more people. Thanks again for tuning in. I'm Stacey Hyde, and this is Better Financial Health in 15 Minutes or Less.